Welcome to today's What Will Move the Market show. I'm your host Prem. It's Friday, January 9th, 2026, and here is everything you need to know as the markets open for today. Let's dive straight into Wall Street's overnight performance. The markets ended on a mixed note on Thursday. The Dow Jones Industrial Average rose 270 points to close at 49,266, a gain of 0.55%. The S&P 500 managed to eke out a tiny gain, climbing just 0.01% to end at 6,921.45. However, the tech-heavy Nasdaq took a step back, declining 0.44% to close at 23,480. The weakness in the Nasdaq was primarily driven by heavyweight technology stocks like Nvidia and Broadcom, which saw selling pressure as investors rotated away from the mega-cap tech space. On the flip side, defense stocks emerged as the big winners, with names like Home Depot, American Express, and Caterpillar powering the Dow's gains. This rotation from tech to more cyclical sectors reflects the market's sensitivity to potential tariff announcements that could reshape global trade. Importantly, today brings two critical pieces of data that could move markets. The December jobs report comes out this morning, and the Supreme Court is expected to rule on the legality of tariffs, a decision that could reverberate across global markets. Now turning to Indian ADRs, which showed mixed signals overnight. Infosys Limited's ADR slipped 1.04% to $18.04, signaling some caution around the IT export sector. HDFC Bank's ADR managed a modest gain of 0.57%, closing at $33.39, suggesting some resilience in the banking space. ICICI Bank's ADR declined 0.19% to $31.32, while Reliance Industries sponsored GDR shed 3.13%, closing at $65.10, a sharper drop likely reflecting the broader weakness in commodity-linked stocks. The message here for Indian investors is clear. There's a flight of capital away from export-oriented sectors and commodity names as the tariff clouds persist. Asian markets this morning present a more nuanced picture. Japan's Nikkei 225 index rose 0.54% overnight, supported by strong performance in fast retailing, which surged over 7% after delivering impressive quarterly results. This showed that despite global uncertainties, well-managed companies with strong domestic and global execution are still attracting buying interest. Hong Kong's Hang Seng futures were trading higher at 26,312, compared to the previous close of 26,149, suggesting a positive opening for Hong Kong equities. China's Shanghai Composite will see focus on its consumer price inflation data, which is expected to tick up slightly to 0.8% year-on-year. Turning to Gift Nifty, which is trading at $26,005 with a gain of 0.13%, this indicates that Indian markets are likely to open on a relatively flat to slightly positive note after yesterday's sharp 1% decline. However, this slight strength should not mask the underlying nervousness triggered by trade policy risks. On the geopolitical and policy front, the overriding concern continues to be U.S. trade policy. President Trump has backed a bipartisan sanctions bill that could impose tariffs of up to 500% on countries that continue to purchase Russian oil and uranium. India, as the world's second-largest buyer of Russian crude after China, is squarely in the crosshairs. New Delhi already faces a 50% tariff on certain goods, 25% as a reciprocal tariff, and another 25% penalty for Russian oil purchases. The potential for an additional 500% tariff would be devastating for exporters and energy-intensive industries. Trump himself acknowledged on Sunday that Prime Minister Modi is unhappy with the current tariffs, but has indicated that further increases could come swiftly if India does not reduce Russian oil purchases. This trade uncertainty remains the single largest headwind for Indian markets today. Domestically, the Indian market landscape is shaped by a continued divergence between foreign and domestic flows. Foreign institutional investors offloaded 3,367 crores of rupees yesterday, continuing their streak of selling that started at the beginning of the year. In contrast, domestic institutional investors stepped in as aggressive net buyers, purchasing 3,701 crores of rupees, providing a critical cushion beneath the market. Yesterday's session witnessed a broad-based rout, with the Nifty 50 closing at 25,876, down 1.01%. Marking its worst day in over a month. The Sensex fell 0.92%. Metals took the hardest hit, with the Nifty Metal Index plunging 3.4%, followed by oil and gas down 2.84% and PSU banks down 2.08%. On the positive side, ICICI Bank emerged as a bright spot, along with Bharat Electronics and SBI Life Insurance. Looking ahead, with no major IPO launches today, the focus will remain squarely on managing downside risks from tariff headlines and capitalizing on DII buying whenever weakness emerges. On technical levels, the Nifty 50 closed at 25,876 yesterday, and traders should watch for immediate resistance at 26,061, 26,126, and 26,231. Support levels lie at 25,851, 25,786, and 25,681. For Bank Nifty, which closed at 59,687, key resistance zones are at 59,997, 60,127, and 60,336, while support can be expected at 59,579 and 59,449. The put-call ratio, which reflects market sentiment, has deteriorated to 0.66, suggesting that investors remain tilted towards selling, and a bounce back towards support levels could be needed before any sustained recovery takes shape. Commodity markets overnight were largely subdued with downward pressure. Gold shed 0.44% to close at $4,057.87 per troy ounce. Silver also weakened, falling 1.66% to $75.69. Crude oil lost 0.65% to $58 per barrel, while natural gas was the sole gainer, rising 0.41% to $3.16. The weakness in precious metals and oil reflects the broad risk-off sentiment that dominated overnight trading, with investors moving to cash and defensive positions ahead of today's critical U.S. economic and legal rulings. Here's the key action item for traders and investors as markets open today. Manage your risk ruthlessly. Yesterday's sharp decline has created a fragile technical situation, where the Nifty remains sandwiched between strong support and overhead resistance. The window of opportunity today lies in two distinct areas. First, if the US jobs report comes in softer than expected, that could trigger some relief buying in India as tariff concerns ease temporarily. Second, wait for any capitulation selling to hit support levels before committing fresh capital. This is not a day to chase strength or build aggressive long positions. Instead, focus on quality names where DII buying interest is evident, and avoid the sectors most exposed to tariffs and commodity volatility. Stay disciplined, stay alert, and remember that volatility creates opportunities for those with patience and a clear plan. Stay tuned for the evening wrap, send in your questions, and subscribe to this podcast to hear US every weekday morning. Thanks for joining us on What Will Move the Market. See you at the close.